Hey traders, this is Blake Morrow with Traders Summit, and I have a very special guest with us today, Adem Tumerkan. He is also the founder of Speculators Anonymous. How are you doing, Adem? Good to see you.
Yeah, doing good, Blake. I appreciate you having me on.
You know, this is pretty neat because I've heard interviews with you before, and I really like the way you think from a macro point of view in the markets. And I really wanted to have this one-on-one conversation with you. But before I do so, and before we get started, why don't you tell a little bit about yourself and about Speculators Anonymous?
Okay, great. Yeah, just a rough summary. I'm just a interested economics enthusiast since I grew up, I graduated high school in 2010, so saw the housing bubble crash, got me really enamored in the market and how just everybody was so fooled by they goosed up the housing bubble and then it popped. And like all the smartest people I knew, including my own father, everyone I looked up to just was sitting there scrambling with their heads cut off. So it really got me into the interest of economics and psychology, which, as you know, it's all kind of tied together in economics. It's like sociology within accounting's basics. And after that, I just started studying economics at college, never got a degree, got lucky, picked up by the guys at Stansberry Research who liked some of my just blogging. And then from there, it just kept going higher, then worked at Palisade Global, great guys. And then I started Speculators Anonymous because I was just tired of once you start working in like the newsletter industry, all power to them, but it's more narrative than it is markets. And I just wanted to go my own route. And instead of talking about something I didn't believe in. And that's just kind of how I got to this point.
And that, I think that's a pretty awesome story. So, and talk a little bit about what you cover at Speculators Anonymous. What facets of the markets do you really focus on?
So I really like macro. I like the big picture. I started in the industry as a micro analyst, mainly the gold resource companies, individual micro caps. But macro was always the one that really interested me because there's such complexity, but within that complexity, there is ebbs and flows, like business cycles. And to me, it's very interesting that you find these long trends. And especially in macro, when micro, in my opinion, is very competitive, macro is more theoretical, which to me is more interesting because you find a lot of experts, like even with the Fed chairman, all these people, they say, like to 2020, they're like, oh, there's going to be no inflation problem. These are supposed to be the smartest minds in the market. And yet not only we're hit with like raging inflation, it's like, how did all these guys get it wrong? So that to me has always been interesting. And I like touching on like a contrarian view when I hear all the experts, who have their agendas and et cetera, not to create panic. They want to keep the wealth effect going, et cetera. I like to look at the opposite view of that and say, hey, is following them offer more reward than risk, or betting against them is lower risk with higher reward? And as I learned from Nassim Taleb, great author, one of the better minds in my opinion in finance, very underrated for finance because he's more of a philosopher, or self-turned philosopher. But his work on finding asymmetry in markets, like low risk, high reward and then you want to bet against situations with high risk, low reward. I think that's extremely important for macro investors.
It really is. So, Adam, I already automatically love the way that you think. And like I said, I've heard interviews with you in the past. So tell us a little bit give us some high level basic views that you have of the current market environment. I know it's kind of a tricky one, but
Yeah.
where do we stand now? And what are your views moving forward, whether it's about inflation, employment, recession, where do we stand?
So yeah, back in December, November, December, I started warning that because, as you and I know, there's a thing called systems thinking, which is basically George Soros kind of popularized this with his theory of reflexivity, which means amplifying feedback loops, like population or a bubble, high prices instigate higher prices, increases mania, and then you see the bubble spiral. But it also works on the other way down. So they're always amplifying cycles in markets. I think Minsky came up with it first, but George Soros really popularized it. And in December, November, when the Fed started tightening, the thing is with my argument was the problem with inflation today isn't monetary inflation. If you look at overnight reverse repo today, it's at what I think it's a record high 2.4 trillion. There's all that money so the Fed effectively, when QE happens after COVID or before, the Fed is saying, hey, we're going to give you we're going to force zero yielding assets onto your bank balance sheets for banks, financial institutions. And zero yielding assets are cash. They're like printing cash, effectively giving it to them. And then they're saying, and we're going to buy your bonds from you. We're forcibly buying your bonds, which are higher yielding assets. Well, the problem we've seen since the 1980s economy is that there's a dearth of investment and a savings glut. They're both two sides of the same coin. There's too much savings. The rich have compounded their wealth faster than global growth has happened. And when you have the wealthy compounding wealth faster, interest rates start dropping because it's like supply and demand. We have too many people. It's not like how you and I can go put our 100 grand under our bed or whatever. You can bury it in your backyard, et cetera. It's how people can do. When you're a billionaire, you need to put that money somewhere. It needs to produce yield. So banks get that money in return. They're like, well, what do I do with this money? So the Fed's theory was after 2008, they said, hey, if we do QE, we're going to force cash onto their balance sheets and buy their bonds, and they'll have to lend it out into the economy. That was the theory, and create a wealth effect, because as you keep lending, it goose up house prices, it creates more demand, et cetera, asset prices. And the problem was after 2020, the Fed, in my opinion, historians are going to look back scratching their head at the COVID situation where they basically grounded the entire global economy to a halt, which has never been done. Even during Spanish flu in the late 1900s, you didn't grind the economy to a halt. It just does more harm than good. And, in my opinion, or I guess historically, it has done more harm than good. And then not only did they grind the economy to the halt, killing the supply side, they created a wave of artificial demand. You had direct stimulus checks, multiple rounds, 3 if I'm not mistaken. They did PPP loans, student loan pauses, mortgage pauses. So while they even did the mortgage pauses, the big one. So they didn't even let people who, it's unfortunate to say, but normally in a free market, the homes, people couldn't afford their houses, they would have had to leave, et cetera, which would have put extra supply on the market. But instead, they just stayed in their homes. And then the Fed on the other end started buying $2 trillion of mortgage bonds. So you're pouring gasoline on a fire, creating a wave of demand when there is no excess supply squeaking into anywhere. So the main supply, so there's 3 types of inflation. You have monetary inflation, historically, then you have supply side inflation, which is, if oil supply like Russia gets curbed, you're seeing oil prices soar in Germany. And then you have demand pull inflation, which is demand side, meaning if the same amount of oil's around, but then everybody just wanted to buy extra gasoline, usually from increasing populations, would create more demand as there's more mouths to feed, more gas needs, et cetera. So the problem we're seeing today isn't really monetary, because we're seeing that it's a liquidity trap. If you look at overnight repo, banks are saying, hey, all that free cash you gave us, we're sending back to you in the overnight repo. Every single night, they're sending back $2+ trillion to the Fed and trying to get bonds back on their balance sheet, showing that they're like, there's demand for, even if it's the squeakiest tiny of yield, they have no better use for that money. And when the Fed started tightening, we've seen that glut of savings or excess idle cash in the banks get even worse. And as you and I have talked about in the past, I know on Forex Analytics, these things have they're leading and they're amplifying feedback loops. So by the time we know we're in a recession, like once we see the Q1 GDP, that means we're basically looking months into the past. So once we saw Q1 GDP in March or April for 2020, and it was negative 1.6, the real nominal, we already know that is a recession basically from months prior. And the Fed's only tightened more aggressively since. And it's only going to make the situation worse. We're going to see cryptos market. We've seen cryptos, the S&P global crypto market's down, 70% almost. S&P 500's down 20%. The more speculative assets fall like dominoes. And you're going to see the riskier assets like NFTs that got, pumped up during that, fat liquidity era pre-2022. They're now going to start retreating the other way, and it's going to cause a negative wealth effect while at the same time the banks are bloated with cash with nowhere to put it. And it's only going to get worse because as they're putting us into a recession, the demand for cash is going to erode in the economy. And that's what I think the Fed is hoping on, because the supply side's been crippled since effectively 2020, March 2020, and then made it worse with the Russia-Ukraine war. We just saw 10,000 cattle in Kansas that died from heat. I mean, that's going to increase beef prices. And then China had their COVID lockdowns. China's the biggest supply side nation in the world, so exporting nation in the world. So you're going to see, while you're having supply side issues, I think the Fed is effectively trying to create a mini recession to pull demand down. So if you have supply down and demand up here, you're going to create higher prices. I think they're effectively trying to do demand destruction, create a mini recession, get people to stop spending, pull it down to equal supply until supply can start increasing after COVID's done, or all these supply chain situations get fixed out, and then demand, and then they can just cut rates and try to stimulate again. That's what I think they're trying to go for at this point.
And that's a great working theory, but how far along are we at this point? I mean, you look at China. If you just look around in China and how like equity markets have responded over the last couple months, they've actually done quite well.
That was one of my things to my premier advisor in March. I said the only country I'm long now is China, because they were the only one easing, because they tightened in 2021 while everyone was easing. And like you were just saying, it's like always a 6 to 12 month lag. So like if the Fed effectively tightened, which they started in November, December, we didn't start feeling it until this summer now. Now we're seeing PMIs and everything crash while prices still haven't gotten under control. So even if they tomorrow were like, hey, we're going to a recession, we're going to cut rates, that's not going to benefit anybody probably until December at the very earliest. So the Fed's behind the curve at this point.
They're still, so what you're saying is they're still behind the curve.
They're very behind.
Okay, so where do you see of us from a, it's pretty much a given. Everybody sees the recession coming. We all know it's coming. Is it coming in 2022? Is it going to come in 2023? And the question I want to ask you is how does the Fed avoid putting us too deep into a recession? What do you think?
So I think the Fed's problem now, a lot of it is like gas prices, and a lot of it is like it's ironic to me that the Biden administration is begging Saudi Arabia to pump more oil when there's a huge amount of marginal oil that can come online in America. So it's a lot of it's bad policy, just short-term thinking. And I think it's, even if the Fed tightens up and creates demand destruction, it's ripping your nose off to spite your face, because you'll get prices under control. CPI is a lagging index. So once we start seeing the CPI declining, in my opinion, we're already in a recession at that point. So if the Fed keeps tightening, like, hey, this is working, let's tighten even more, it could create a huge recession, especially because of the negative wealth effect, because since 2008, it's like the global economy is kind of like hobbled along depending on asset prices and debt. And if you raise borrowing costs while living costs have gone up, it's hard to really even fathom what they can do at that point. Like if they even cut rates back to zero, will that be in time enough, or will that even be enough stimulus? Because you lose marginal returns. We've had rates at zero for a decade, and every time they raise it 2 to 3%, they immediately have to go back lower. So the return, like we saw in the COVID stimulus, even cutting rates zero didn't really help. They had to like pump in an enormous amount of stimulus. So next time, I wouldn't be surprised if we even see record bigger deficits and et cetera.
So, right now the rates market's suggesting that there are rate cuts coming,
By 2023. Yeah. I mean, the yield curve is about to invert for the second time. The 10 and 2 year yield curve, which is a historically canary in the coal mine, it inverted in April, which showed, hey, the data is deteriorating. It did a great job of forecasting it, as it usually does. And it's about to recede into negative territory again for the second time in 3 months. And the only time that's ever happened was in 2008. So like you said, if the credit markets are expecting it, they're betting probably that the Fed's going to go to zero in 2023. They're going to have to cut it back down to zero after all this.
Amazing. Adem, where are you telling your Speculators Anonymous subscribers, where are you telling them is a good place to have your money, and what are you telling them to avoid? Whether they're individual names or sectors of
Yeah.
the market. What are you thinking here?
So as a macro, like I said, back in March, I liked China, long China, just calls on China. I'd rather lose the stall money, the small premiums, but lock in that 12-month long dated calls, because if China keeps doing well, you can make a lot of money. And worst case scenario, I lose a little bit of the premiums paid. So to me, that's asymmetric. And right now I'm looking at bonds because the yield curve's inverting. You're going to start seeing investors, because like we were just talking about, there's a glut of cash in the banks. And once yields are at these higher levels, these banks, it's like all that supply is coming on. It's like a blanket weighing down yields. And I've seen people that are like, oh, why, if inflation's at 8-9%, why aren't yields high? It's like, because there's such a huge amount of savings with nowhere to go that the demand is so overwhelming on whatever bonds are out there. And we've seen the Fed and the fiscal side have both cut back. Like the fiscal impulse indicator, which is a big one, in my opinion. People can find it on the Brookings Institute website as a good one. It's been negative for the last 3 quarters. So we've seen, after that huge COVID stimulus, which central bank treasuries had to issue bonds to raise that capital to give to people, they cut back. But that capital is still in the system. Those printed dollars are still there until the Fed does enough QT to erase it all, which they won't, because that would suck too much out. But at this point, it has been a soft tapering, because there's just a massive amount of savings in the banking system waiting for any marginal rise in yields to weigh it down. And I think that's what we're going to be seeing. I don't think we're going to see yields go too much higher. So I do like bonds at this point, just because like Japanification it's a global trend. Demographics is one of the biggest trends for bonds, or even deflation. And the Roe v. Wade, I even have a idea that we're seeing once a year after the Social Security office came out and said there is not enough young people being born to subsidize the older, and people are living longer. So who knows, maybe that played a role in, hey, we got to just, make it so that more children are born, because how else are you going to sustain the old? And in Japan, we're seeing 300,000+ people died last year, more than were born. Europe is following right behind it. America's not too far behind it. The fertility rate's at a 220-year low. In fact, if you look at the fertility rate in the U.S. history, there's only been one upswing in all of its history. And most of U.S. history has been deflationary. But the one inflationary period was between post-World War II. And that's the only period where fertility actually had an upcycle, between 1945 and 1962. Was the only, what we know as the baby boom. It was the only up. And now we're just seeing it back at a record low. Birds are dying. We're seeing the savings glut that was built up by actual private households is now gone, all that excess savings. So, yeah, I just think that bonds at this point looks good until the Fed starts cutting, which I don't think they're at that point yet, but I'm getting a position for, because once we do see them cut, you're going to see the speculative assets, as always, you're going to see them get a revival.
And where would you want to be? Like if the markets start rallying because you see that pivot in the Fed, where would you want to be, and what sectors would you be looking at?
Even though I'm not a big crypto person, I would say as a speculative asset, probably crypto, because it's sold off so hard. And that's usually, like we said, like higher order effects. You're going to see Fed easing trigger the biggest gains in the more speculative assets. Just likewise, we saw when they tighten, you see the more speculative assets suffer the most. So I would say maybe a crypto index off the top of my head. Emerging markets, they would feel the excess flow. Once also the records, the 20-year high US dollar at this point is strangling emerging markets with record level US debt. So, EMs would probably get a nice boost. That's kind of the things I would look for, more speculative.
That makes a lot of sense. Well, Adem, I love the way that you think, and I hope this isn't the last time that we meet. I hope we get to meet again soon and on a more regular basis. But as a trader, if you're watching Adem at home, make sure you give him a thumbs up. If you're watching him for the first time on YouTube, subscribe to the channel. But how do I follow your work on a daily basis, Adem? Tell us a little bit about that.
Yeah, so I'm on Twitter at just Radical Adem, and it's spelled ADEM. And then my website, speculators.anonymous.com. And those are the two, Twitter, I'm daily and posting free stuff on my site.
Awesome. Well, Adem, it's great to talk with you. And I'm glad you and I got to meet finally face to face. And I'll look forward to the next time we have an interview.
Yeah, I agree. Thanks, brother.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.